to Money, Money, Money. I'm Sumera Abdi. The festive season is around the corner, but some of the cheer has been dampened because of the increased volatility that we've seen in the market of late. Will 2016 fare any better? Will Diwali bring a revival in investors' fortunes? We'll pose all of those questions this week to one of the best fund managers in India, Harsha Upadhyay, Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, thanks very much for joining us in the middle of earnings season. I do realize this must be a very busy time for you, so thanks much. I want to actually start off by asking you about your assessment of the year gone by. How is it from a fund manager's perspective? I mean, for one, I do know that retail participation has gone up of late this year, but does it look likely to sustain?
From a fund management perspective, I think the previous year was quite challenging. You may not see that if you look at the index movement, because if you look at the last 12-month performance, the broad indices have been more or less flattish. But within that, the sectoral and the stock performance have been quite divergent. So as long as you pick the right sectors and stocks, the performance was good. Otherwise, broadly, the markets didn't do that well. Fortunately for us at Kotak Mutual Fund, the team actually came up with the right sectoral as well as stock selections, and that has helped us in terms of giving outperformance against respective benchmarks. Your second question regarding retail participation, I think clearly that's been on the uptrend. We have seen consistent inflows into the mutual fund industry over the last 18 months or so, and there seems to be no let up in that particular trend. We continue to see similar money coming into equity mutual funds month after month. We believe that this trend will continue even going forward.
Okay, so what's the average ticket size then from retail clients? I mean, I'm just trying to understand actually whether the small investors, who normally end up catching the tailwind, whether those guys are actually using this opportunity to enter the market.
Usually, if you look at the SIP book, that gives fair indication of what retail investors are thinking. If you look at the overall SIP book today, that's gone up to about 30,000 crores per year for the equity mutual funds as a whole, which is almost 40-45% of the total inflows that the industry has been getting over the last 12 months. So clearly, this number has moved up from about 24 or 25,000 crores annually to about the current levels of 30,000 crores. And also if you look at the average ticket size, that has moved closer to about 3,000 rupees per month per application as compared to somewhere around 2,500, which was the case earlier. And also in terms of the new folios that have got created in the industry, in the first 3 months of this financial year, we have seen close to about 9 lakh new folios getting activated in the industry. So clearly all these actually point to a robust retail interest that's coming into equity mutual funds, and even today the penetration levels are very, very low when you look at equity mutual fund products in the overall household savings. So to that extent, we believe that this trend can only gain momentum going forward, and we don't see any change in the momentum.
Okay, so for all of those who've actually taken the plunge, say in mutual funds this year, what kind of a time horizon should they be looking at to book profits, or would you also advocate investing only with specific goals in mind?
Usually, goal-based investing actually helps building a long-term wealth. That also imparts a lot more discipline into investments. So we usually advocate goal-based investing rather than target-based investing. If at all one is not comfortable with goal-based investing, then one should at least look at investing for a minimum of 3 to 5 years in equity mutual funds, if not more than 3 to 5 years. So long-term investing definitely helps withstand the intermittent volatility that may be there in the funds and the market, and finally you will come out with more wealth, in our opinion.
The most common question that we receive actually from investors is, which fund do I choose? So let me actually pose that question to you now, because your own funds have actually been top of mind for many, many investors. So how does one actually choose a fund? I mean, is it the past performance, or is it the fund manager's own track record? I mean, how does a small investor even judge a fund manager?
It's always mentioned that past performance is no indicator of future potential. which is very true. But at the same time, one cannot really ignore past performance. One should look at the past performance in various kind of parameters. It's not just point-to-point returns, but if you analyze past performance and see whether the fund has been consistent through market cycles, through time periods, and also whether the fund had taken excessive risk or had taken moderate risk, whether it was consistent in terms of the investment philosophy of the fund. So these are some of the factors you need to look at when you are analyzing past performance, which can actually give you a sense of what has happened in the past and what you can expect. If a particular fund house or if a particular fund is following a process-based methodology in terms of investing, then obviously that consistency can get repeated. But if it's not coming through any process and if it's purely a matter of chance, then I do not think that can be replicated going forward. Along with that, one also needs to see whether there is coherence in terms of the portfolio construction, in terms of what the investment mandate is, whether the portfolio is getting constructed in the similar manner, whether that consistency continues with time, and also the fact that whether the fund house that you are investing into has the management bandwidth to take care of the fund management responsibilities, whether it can attract talent and retain talent. So these are some of the things that one needs to actually look at. Obviously this list is not very exhaustive, so it's always better to go through a financial planner who is qualified, who can help building a portfolio of mutual funds.
You know, a recent report has actually highlighted that there was a significant opportunity to channel some nearly 12 lakh crore rupees of household savings into the capital markets, you know, in the coming years. But within equity also, the lure is always of direct equity. You know, mutual funds sometimes score lower on the adrenaline factor. So despite burnt fingers, you know, we've seen that investors cannot shake off this sort of an urge. So can you build a good case for these investors to actually be looking at mutual funds?
Investing is really a serious business. I do not think that anybody should approach investing, especially stock market investing, in terms of trying to get some thrill out of it. As far as overall take on direct equity versus mutual fund, I think clearly while many people invest in direct equity than in mutual funds, I really do not know whether as a portfolio over a long period of time, all those direct investments, whether they have really outperformed the benchmark or not. If you look at the mutual fund industry, on the other hand, has clearly outperformed over a long period of time on a superior risk-adjusted basis. And I'm talking about industry as a whole. So clearly, for small investors, rather than trying their luck in equity markets, it makes sense to actually look at equity mutual funds, which are professionally managed. So clearly, there is a case for entrusting that money with professional fund managers who can manage it better and who can take known risks rather than blindly betting on various things.
Well, what about mid-caps or sectoral funds then? I mean, has the time come to be a zebra in lion territory?
Clearly, the mid-cap funds at least have outperformed diversified equity funds or large-cap funds over the last 18 to 24 months. Obviously, we were coming out of an economic downturn and the valuations were much more reasonable in case of mid-caps. But over the last 18 to 24 months, the valuation cushion that was there in mid-caps vis-a-vis diversified funds have narrowed. In some cases today, the valuation of mid-cap stocks are more or less similar to the large caps, or maybe even more than large cap stocks. So to that extent, one needs to have a slightly more longer term approach in terms of mid-cap funds, and also one should not be worried about volatility, because inherently mid-cap stocks are going to give you more volatility compared to large cap stocks. So one should, if one is investing today, then he should be ideally looking at next 5 or 7 years, where the economy is expected to rebound quite substantially, and that is when the mid-cap funds will actually give you more wealth compared to a diversified fund. And as far as sectoral funds are concerned, I think one should be very careful in terms of selecting the sector depending on the growth prospects and valuation. And also the entry and exit have to be managed well in case of sectoral funds, because the trends keep changing every few years in terms of which sector is going to do better than the rest. So usually the sectoral funds have to be kind of a top-up options. Only when somebody is willing to take extra risk, one should maybe put a small proportion of the money into sectoral funds rather than keeping it in diversified or mid-cap funds. This is what I would advise.
You know, Harsha, if you analyze a lot of the funds, we do see that a lot of mid-cap funds would keep, one or two large-cap stocks, or we'll see that a sectoral fund has a stock which is somewhat resilient, but altogether from a different sector. Why is it that they don't actually stick to their allocation?
You are right. I think having large-cap stocks in the mid-cap portfolio has been more of a recent phenomenon where the funds have consistently got inflows. And also the valuation differential between mid-cap segment and the large-cap segment have been more or less not there. Since the valuation gap is not there, it makes sense to have a little bit of large-cap stocks in the portfolio to provide stability if that is allowed in the investment mandate. And that's what probably some of the mid-cap fund managers are trying to do in the recent times. As far as having a pharma stock in an infrastructure fund, for example, I think that's a strict no-no from our fund management perspective at least. We want to be true to label sectoral fund managers wherever we are managing sector funds. And we believe that that is the message that the investor gets. I mean, when he reads a particular fund as an infrastructure fund, he believes that it is going to invest in infrastructure funds, and if that is going to invest in a pharma or an IT stock, obviously that is not entirely right in our opinion.
All right, on that note, it's time for us to take a very quick break. We'll come back in just a bit, and when we return, Harsha Upadhyay is actually going to help us understand the investment trends for the coming year. Do stay tuned to Money, Money, Money.